Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. I trust you're all having a good weekend. My apologies in advance. There's a little bit of construction not too far from where I'm recording. Hopefully it should not be too disruptive or distracting, and we'll just push through with today's video, which is very much an economics and finance heavy episode, by the way. Before we discuss China's devastating stock market woes and moves this week, let's discuss the economy and specifically international business and investor sentiment towards the PRC. Yesterday, Friday, the American Chamber of Commerce in Shanghai published its annual China Business Report. The findings and outlook in the report is a mixed bag. More than half, 55% of the approximately 300 companies surveyed by the American Chamber of Commerce in Shanghai are optimistic about their 5-year business outlook in mainland China. 1 in 3 of these US companies cited growth potential as the primary reason for optimism. We remember yesterday, for example, a bullish Boeing published its forecast for growth in the Chinese aviation market. However, nearly 1/5, 17%, said that they were cutting investment in China or moving operations out of the country. The main reason being recurring COVID-19 control measures, like shutdowns, travel restrictions, and supply chain disruptions. Indeed, 80% of all companies said that zero-COVID restrictions have impacted supply chains. Deteriorating US-China relations was also a popular concern. Quote, "Rigid COVID measures have upended business performance expectations and optimism. To restore business confidence, China should pivot to a more sustainable approach to managing COVID based on a reasonable balance between public health and the economy." End quote. The report writes too, quote, "Headquarters executives are unwilling to travel to China given the onerous COVID restrictions, and this in turn blighted China's appeal to foreign venture capital executives and senior multinational company executives." End quote. There were more pessimistic details in the report too. Less than half of the companies projected year-on-year revenue growth for 2022, the lowest expectation in a decade. 47% expect their revenue growth in China to outpace their global performance though, which is not bad, but still down 22 percentage points versus last year. Only 30% of companies said they increased investment this year, down from 38% in 2021. When asked to list the most important long-term macro challenges that China faces, the top 3 issues identified by respondents in descending order of importance are the complete decoupling from the United States, the housing market crisis, and population decline. Meanwhile, moving from businesses to investors, according to data from China Central and Depository Clearing Co. and Shanghai Clearing House published yesterday, Friday, foreign investor holdings of Chinese bonds in the interbank market fell by 70.7 billion RMB, just shy of $10 billion in September, representing the 8th straight month that global investors dumped China's onshore bonds, the longest streak on record. In September, international capitalists sold a net 35.8 billion RMB of Chinese government bonds and 20.8 billion RMB of quasi-sovereign policy banknotes. Analysts argue that the fall of the Chinese currency and surging treasury yields have conspired to intensify bond outflows in September. Quote, "Continued outflows amid the Fed's aggressive tightening in September were expected, and the market may need to be patient before global buyers return." End quote. Now let's end this part on global investor sentiment towards China with a development which will no doubt invoke no small degree of schadenfreude with some viewers, a development that also touches on our second section of this video. In a move which now, in hindsight, is the butt of many Wall Street jokes this week, but more importantly, a sign of just how poorly international banks and other investors read Beijing's political waters in the lead-up to the 20th Party Congress, Goldman Sachs Group Inc. told investors in a note dated the 17th of October that they should sell S&P 500 index calls in order to fund buying of the same options on the Hang Seng China Enterprises Index to position for a likely catch-up. Regular viewers for China Update know of course that the Hang Seng China Enterprises Index was smashed this week. More on this soon. Since the professional advice was given to Goldman's investors on October 17th, the S&P 500 is up 6%, while the Hang Seng China Enterprises Index is down over 10%. From a fundamentals perspective, the bet wasn't terribly far-fetched. The Hang Seng China Enterprises Index has dropped 31% this year, compared to a 23% fall in the S&P 500 index. The problem is, it's now clear that many investors expected zero-COVID easing to come after the 20th Party Congress, while others were also surprised by the Politburo Standing Committee lineup. But as we know here on China Update, there were plenty of signs, especially in authoritative state media, which we followed closely in the lead up to the 20th Party Congress, which told us very much what to expect. Perhaps the folks over at Goldman Sachs should subscribe to China Update. It might save their clients some money. But you guys already do, for which I am very grateful. Thank you so much everybody for all the support. For me it's a pleasure and an honor to be able to make these videos for all of you every day. I've heard from many viewers this week that some of you have been unsubscribed from the channel for some reason. It may be worth checking that you are still subscribed just in case, and maybe hit that like button too if you're enjoying this video. And as always, making videos every day is almost a full-time job in terms of time. So for anyone who can go the extra mile and who thinks this channel is worth a damn, Patreon and Buy Me a Coffee links are in the description below. This channel is kept sustainable primarily through subscriber support and not corporate sponsorship, which is how I want it to remain. So this sort of support is a massive help. As always, thank you so much everybody for the ongoing support. Next up, it's been a bad week for Chinese shares. Now that it's Saturday, let's get a sense of the damage, which one analyst described yesterday as jaw-dropping. Quote, a spectacular $6 trillion stock market blow-up came to a head this week after President Xi Jinping secured a third term surrounded exclusively by close allies. Investors rushed to exit Chinese shares, triggering an epic rout on Monday. The sell-off resumed with a vengeance on Friday, sending an index of Chinese shares traded in Hong Kong to the lowest level since 2008 and turning it into the world's worst performing stock gauge for the year. End quote. The Hang Seng China Enterprises Index, which we just touched on, was down almost 9% this week, losing 7.3% on Monday in its biggest one-day plunge since 2008. After some rebound in the following days, the index was smashed again, 4% down yesterday, capping its worst ever 5-day loss following any party congress since the gauge's creation in 1994. The Hang Seng Tech Index tumbled 5.6% yesterday. Indeed, there is more news on the US-China technology war front. We may have to do a special Sunday video tomorrow because there is simply so much to cover from this week. At the beginning of the week, the Nasdaq Golden Dragon China Index in the US tanked a record 21% during intraday trading. Such was the volatility of the initial market shock. On the mainland, China's benchmark China Securities Index 300 capped the week with a loss of 5%, its worst performance in 15 months. And Goldman Sachs analysts were not the only ones surprised by the performance of the Chinese shares this week. Quote, I was unprepared for the depth of the sell-off. A lot of investors and analysts were caught with their pants down. End quote. The president of Beijing-based China Vision Capital told Hong Kong media yesterday, quote, the market is in chaos. End quote. Indeed, many investors and analysts, whether in the mainland, in Hong Kong or wider Asia, or in the West, were simply not expecting the week we just saw. Quote, the magnitude was surprising. No one ever cared about fair value of companies and just wanted to sell. I think the future for the stock market is still bumpy. Lots of people will continue selling because it's very, very difficult to price in the future under the new leadership. End quote. As of this week, the total sell-off in Chinese equities onshore and in Hong Kong has reached around $6 trillion since a peak in February last year. Okay, that is today's episode of China Update. There may be a special episode tomorrow because there are several developments from this week that we really do need to cover before we move into next week's new developments. So, I may see you tomorrow. I hope you all have a wonderful weekend. If there is not a video tomorrow, I will see you all on Monday.